Nothing has changed for 30 years since I was a 5-year-old child. And I'm still looking at the same wallpaper and floors and carpets, which is driving me slightly insane. But apart from that, everything else is okay, Scott.
Excellent, thanks, Alex. David, I'm not sure if you're on live there yet. I know that
I am here. I am here. I'm doing all kinds of magic with my setup, which is a little complicated, but thank you. I'm back, and I am speaking to you from Bergamo, Italy, which until yesterday was the epicenter of the global pandemic. We kind of passed the baton to New York now, to the United States in general, but specifically to New York. And the situation here is still very, very complicated. Maybe we will talk about it more during the conversation later on.
Excellent, David. Well, wonderful to have you online, and also to see that you're safe there. And yeah, fascinated to hear your insights. Finally, James and I have known each other for a long time. James immigrated to America, has been there a couple of years. And James, what's happening on the ground in America? David's just passed you guys the baton, so I thought it would be a good interview to you.
Yeah, well, well, good evening, good day, good morning, everyone. I'm here in Georgetown, Kentucky, so fortunately far away from New York, but we are in lockdown here, recommending no contact, and just the last day or two actually stopped travel out of the state for essential services. So most businesses are closed here apart from essentials, and a lot of persons working from home.
Excellent. Well, welcome to all of you. Wonderful to have you. Sorry, James, did I cut you off?
No, so apart from that, we last carrying on.
Awesome. Well, wonderful to have you all online. We've got people from America, from England, from Bali, from South Africa, from Amsterdam, from Namibia, from Belgium, Zambia. So it seems like we've got a pretty widespread of people from all over the world. Wonderful to have you all online. I wanted to share some slides with you quickly, just to sort of set a little bit of context of what we're trying to do. This was an idea that the team came up with. It was We're living in a lot of chaos at the moment. And there's a great saying by Napoleon, the right information at the right time is 9/10 of any battle. And I think the idea was really, we don't have all the information, but maybe collectively, if we can ask a bunch of different people in different spaces, we can have a great interactive conversation tonight where you can ask the questions, I can ask the questions, and collectively we can get the understanding. We talk a lot about the concept of Wealth 5.0, and I don't have time tonight to go into it, but in simple terms, Corona is just pushing us faster, the coronavirus, into this space, which is where it's about solving people's problems. It's about creating value. The more value you create, the more money you're ultimately going to make. The more people you can add value to is critically important. How many people you can connect with, how you can use technology to do that, and ultimately in the digital world, how you can solve problems for people and future-proof them. We make it really simple for people, and if you like what you heard tonight, we've got a thing called the Starter Pack. I will share with you later what that involves, but you could literally get started investing in some of the property deals you're going to hear about tonight, and property markets and property partners from $100. You get access to the inner circle, which gives you access to what James is going to be sharing around currency and predictions and everything else. You've got access to the different micro degrees, and even to deal with one of our partners. And although it's a huge amount of value, we actually make it really affordable. It's literally $197, which includes the $100 voucher to be able to invest. Why am I telling you this up front? Well, because when you're on the webinar tonight and you're thinking, right, the world's in chaos, do I sit on my hands? Do I do something about it? Do I take advantage? I wanted to give you a simple and easy way that people can participate. And equally, the marketplace is live, and good deals and good partners are available on the marketplace. What I wanted to share with you with regards to this update is that we're going to have 5 different authorities in 5 different areas. The first is going to be James. I've actually known James for more than a decade now. He very kindly wrote chapter 2 of my book, Property Going Global. He's a specialist in understanding not only currencies, but predicting now, even in the crypto space, where things are going. The way I've always understood it, and he'll go into it in more detail, it's like the weatherman. They spot patterns. And what I found fascinating over the years is that even when my common sense told me otherwise, often James's predictions would be opposite to my common sense. And yet I've been overwhelmed year on year how often and the accuracy that they've had. And so rather than get caught up in the sentiment and the hype, let's rather look at the facts and the figures. David is someone that I had the privilege of meeting a couple of years ago. He's one of the first people to invest in the cryptocurrency space. He's a venture capitalist and bases himself normally out of New York and Italy, although at the moment he seems to have chosen the 2 epicenters of the world. He's a faculty member of Singularity University, and he really is a global authority in terms of exponential technologies, cryptocurrency, blockchain, etc. And really a very good, has an amazing ability at looking into the future and where we are all going in terms of the world. You've got Ken Williams, who's one of my business partners. He's an investment banker out of London with 25 years experience. He really started to understand the fintech space in the last couple of years. And with regards to our company, we did this event over the last couple of weeks and gave people fascinating perspectives on the marketplace, what's happening in the global, around stock markets, etc., etc. Then we got Brendan. Brendan and I have known each other for a long time. In fact, Brendan and I were the 2 people, along with a guy called Neil Peterson, to fly to America in 2012 to actually buy property. Brendan's been buying property in America since 2011. As you've heard, he's immigrating to America based on his property investments, and has built a company where not only in the beginning did he help us build Wealth Migrate, but he's now built a company called Infinity and built a portfolio of over $250 million of American real estate in America. And then Alex, I was trying to remember, Alex, I think you and I met through Roger Hamilton a number of years ago. And so again, at one of those, where's the world going? How do we create the future together? Alex has a long history in property and property development, specifically in the UK. And what I've been fascinated by is that we have a kindred spirit in the fact that he loves to educate people and then provide opportunities, very similar to what we've been doing for a long time. And so tonight is here to not only educate us, but to tell us what's happening on the ground in the UK property market. And then finally, from myself, I'm not going to give myself an introduction, but I am here. My partner, Richard Dunn from Australia, it's like 3 o'clock in the morning, so I got a full update from him on what's happening in the Australian market. I can also talk with authority as to what's happening in the South African market. And if we've got questions around either Australia or South Africa, I will be looking at those. In terms of our business model, well, it's a pretty simple business model. We go out and we find trusted partners around the world. They basically list their properties onto the platform. You and I from all over the world get access to them. And then there are 4 simple steps upon which people can actually transact. However, I always say to people, there's only 2 things you need to know when you invest. The first is that you get the right information, and the second is that you get the right partners. And so tonight is to solve both of those. We want to be able to give you the right information, and equally, I want to introduce you to some amazing partners that we've worked with for many years. So if you don't mind, and if the 6 of you are ready, well, 6 including myself and Lee, so 7 of us, is there anything that I forgot from any of you in the introductory phase that you would like to correct or change? I thought we'd get much more value by asking questions than giving long resumes, but I want to make sure there's nothing I forgot.
Well, you didn't highlight the fact that my photo is glare-faced, and I have a huge beard now.
I must admit, David, I can see that in Italy you've been in lockdown for a long time. Obviously, barbers are scarce in Italy at the moment.
Absolutely, and I am very nice up here, but I don't show my pajamas down there, right? Because that's how we live today.
Fantastic. Anyone else? Any other comments before we get started? Let's rock and roll then. Thanks. So let's rock and roll. James, I'd like to start with you. I'm going to follow an order upon the order upon which we, even sent out the invites and everything else. And I'd like to start with you've been amazing at spotting patterns. I know you use fancy things like the Elliott wave curve and everything else. I've never fully understood how it all works. But what I have understood is it's spotting patterns like the weatherman. And 100 years ago, most of us would have died if there was a flood or a tornado or a hurricane or even a drought. Whereas today, we spot patterns, or the weatherman spots patterns, and with actually a huge amount of accuracy tells us what we can expect the next day. That's what you sort of really focused your life on and become an authority on spotting patterns. What are the patterns telling us? You said to me before the webinar started, you've looked at some patterns as far back as 1929 when we had the last crash, etc. I don't know if you want me to share my screen, change presenters to you, because you had some graphs that you wanted to show people.
Yeah, I think it would be good, Scott, to just go through a couple of charts here, slides to share with everyone. How do we?
Well, I've given you access, so you just say accept, and then it'll take control.
Screen.
And just while James is getting that up, if anyone's got any questions, please fire them through. I'm going to be moderating and trying to keep the flow of the conversation going. If I'll either ask the conversation while the person's speaking, or we'll round up to a Q&A towards the end. We will try and answer all questions.
We're showing my screen now?
Yep, we've got your screen. If you can just put it in presentation mode.
Yeah. So, I don't think we need to go through. You've already done the intro, and we can perhaps come back to this. What we do is provide forecasts on dollar, euro, and rand on the South African side, and then Bitcoin, gold, euro, and dollar index on the global side. But with a promo for today on the dynamicforexsolutions.com. But just to get just something to share is what actually drives the markets, how it works, and then the current global picture of recession or depression and our outlook on the currency stocks and cryptos, etc. Just quite simply, is exactly what you said, Scott, is that weather patterns repeat themselves. If you look at any there's cycles in nature, and one of those is weather patterns. And so as you can see here, we've had these hurricane season hitting the US. We've had able to predict those through understanding the laws that govern those patterns. And the more we understand those laws of nature, the more we are able to predict future patterns. And it's no different with us as humans, because price patterns in markets are merely a reflection of emotionally charged decisions and actions. And we govern by the laws of human nature. So these patterns recur repeatedly, just the same, in smaller and larger degrees. And the more we understand those patterns and the laws that govern them, the better we can forecast the future patterns. So really what we do is, it's based on Elliott wave, which is the study of human behavior in financial markets. And just like you get all these trends in nature, ebb and tide, growth and decay, and so on, so you get it in any financial market. And in essence, what we got here is that when persons are negative, we're sitting at a low, and then the market moves up and down and up to a point where there's neutrality, and persons start getting more and more positive, to a point where they're very positive. See, these are actually the wrong way around. But we reach a point where everyone has reached an optimism or euphoria, and there's no one to push the market further up. And then what happens is we get a correction of that in 5 waves. Sorry, in 3 waves off this trend. So we get a trend and then a counter trend, and then the trend resumes. And another way of understanding that is with the fear and greed meter, is that at a low point, there's extreme panic, or actually despair. And as the market moves up, we get more to a neutral sentiment, and then the point at the top here, where there's extreme greed or euphoria, and the market then capitulates, and we get fear, as we've had now, and then eventually to a point of despair. And this is why it actually makes it very difficult to make objective decisions, because at these points where everyone is positive, that's not when you incline to sell. That is when you need to sell. And at the same time, when we get to these points of extreme fear and despair, everyone is negative, and you yourself are negative, but at that point, you actually need to be positive. So, that's the science behind what we do. But the question is where we are now. And just we're going to share a few slides there with you on that. But to come back on those patterns, this is a forecast we did back in 2016, so 2.5 years ago, where we showed the market was likely in, here we've had a 5-wave move up, and then a 5-wave within this last 5th wave, which is likely to top out. This is the S&P. At that point, it was 380. It actually went higher than that now. But what it looks like is we most likely have had a completed 5-wave move up here in the S&P 500 or US stocks. And a similar situation with on the JSE, that we were in the 5th wave of a 5th wave. So expecting a major decline from those levels. And just to understand where we are, and to what the problem is. We need to go back to 1929. And here we can see in the roaring 20s was this black line is US debt as a percentage of GDP. That we had just had a credit expansion to a point where the bubble burst. And then what we had is a crash and deflation coming in all the way through to here before we started picking up again. And as you can see, well, this went to 2013. It's the data that's published by the Fed is a bit different now, so I hadn't updated it. But we're actually at a worse point in terms of debt to GDP than we were back in 1929. And what the Fed is doing, and everyone else is actually throwing more debt at it, which is not the solution. That's just adding to the problem. So we can see a global debt has swelled since 2014, since 2007. Yeah. And public debt has actually increased phenomenally compared with household private debt, which has pretty much remained flat, but is still at high levels. So I think this is probably the picture to show. If you look at this is a picture of the Dow Jones from here's 1929 all the way through to where we are now. And if we look at this from a pattern perspective, we ended a pattern here in 1932, and that from there we've had a 1, 2, 3, 4, 5 waves up, which are now made up of 1, 2, 3, 4, 5. If that is the top, what happens in markets is that we're likely to come down into the previous 4th wave. So that's the minimum that we're looking at here. If we're looking at these 5 waves. If this is a 5-wave move up from here, then we're likely coming down to these levels. So, I mean, these are quite shockers, Scott. We've already dropped 38%, but minimum we're looking at here is 72. But more likely, if this is the peak, stocks are going to drop by over 90%. So quite a picture. But in terms of whether we have actually topped or not, the outlook, our analysis is yes, we have. But as we are presently here, it's looking like we could have a move up before, if we break below the low that we've seen this past month, then definitely we have topped out. But there is a chance we could, outside chance, we could have a final fling up before we capitulate. So if we go back to 1929, we are most likely here. But there's a small chance that we are here. So with one more last hurrah up. But, just looking at sentiment, just general sentiment at the moment, I'd say we've reached, fear and panic, but not despair, which would make it more likely that we are here rather than here. If that makes sense, Scott, on the big picture.
No, thank you very much for that.
I don't know whether yeah.
What's that, sorry?
Yeah. No, I'd say there are some more pictures or charts in view of some of the global markets, but I don't know whether we want to
let's come back to them. I'll pivot back to them just now.
Yes.
What I'd like to do, and let's leave that. We'll leave that slide up. David, from your perspective, as someone that I've always been fascinated by your understanding of technology and where the world's going and the big macro, picture and even cryptocurrencies. What do you take on what James has just said around, the global economy, fiat currencies? There's a lot of talk that cryptocurrencies are very volatile, but maybe their time is coming now as people are going to lose faith in fiat, et cetera, et cetera. What's your take on where the world is and where it might or might not be going?
So I am not an expert in charts and in patterns, but I do look at, like you said, fundamentals in not only the stock market or the valuations of companies, but actually what is going on in the world. And certainly, if black swans are going to happen one after the other, as we say, all bets are off, right? But there are big differences between how the world was 100 years ago and how it is now. The biggest difference is that today we are 8 billion people, and 100 years ago there were 2 billion people or less. And that very simply means that even if we do nothing else, just eating and housing and healthcare and transportation, all these industries have fundamentals for products and services to gather to the fundamental needs of 4 times as many people. To me, that says that if stocks go down 99%, they will represent a huge buying opportunity, because that wouldn't be justified by the fact that 8 billion people need to do all those things that I listed. Now, going into the second part of your question with regards of Bitcoin and cryptocurrencies and blockchain applications, it is a very common, actually universal feature of exponential trends that on one hand, we had a hard time wrapping our heads around them. But when we are recognizing them as such, we are going to overreact at the beginning, those of us who believe in their power. And then when they are at a point where they are overtaking us, even if we are planning for them, we are going to be very surprised or even thrown into chaos because all of our planning wasn't sufficient for understanding the consequences of these phenomena. And obviously, we are very right in the middle of one of those. There has been almost no country that has been able to properly plan for the COVID-19 pandemic. There are less than a handful of exceptions. Taiwan, Hong Kong, Singapore, to some extent South Korea, maybe Germany, and I am not aware of any other. One of the worst, it looks like, is the United States of America, that had 2 months advance notice and did nothing to minimize the impact, the negative impact on their population. So just like the internet has been a fundamental technology on top of which over the course of 30, 40, 50 years, because to a lot of people watching this webinar, maybe it looks like the internet is only 5 or 10 years old, because that is when it started impacting their lives. The internet is actually 50, 60 years old. And just as the internet took time to build, but now it has profoundly disrupted almost every possible corner of the economy, and it has impacted net positively the lives of billions of people. Similarly, cryptocurrencies, Bitcoin and blockchain applications are going to take time. It has been 10 years. and some people are saying, oh, it is too slow. Fewer and fewer people are saying, oh, it is a scam. It is just like the Dutch tulip mania. It is going to go to zero. And to those people who are so fundamentally skeptical, I ask, don't you think that the time we are in right now would have been the perfect moment for Bitcoin to go to zero if it were a scam? Who cares about Bitcoin if it has no real value, no staying power during a pandemic? And yes, it would have. It did go down from its all-time high exchange rate with the US dollar, for sure. But it hasn't crashed. Its network is performing as solidly as ever. So what I predict is that as more and more people are going to learn about it, build applications on top of it, prove that it is valuable, the more its value is going to increase because of the network effect of users wanting to get on board with the technology and the knowledge and the power that it represents.
Excellent. No, thank you very much, David. You know, Ken, from your perspective as an investment banker, you've heard the forecasts in terms of sentiment. David's obviously given the forecasts in terms of current, not so much currencies, but technology and cryptocurrency, etc. What is your thoughts on what's actually happening in the financial markets? A black swan. David mentioned a black swan, but what is a black swan? And where do you see the financial markets going?
Thanks, Scott. So surprising to see your opening slide with regard to Napoleon, because down the line of uses information, Napoleon's second wife was a woman called Marie Louise. She was an 18-year-old, and she had a menagerie of animals. And Napoleon brought her the only breeding pair of black swans. And in fact, they are heralded as the key European breeding pair that has supplied the whole of Europe with black swans. In actual fact, black swan theory came, many centuries before that as a null hypothesis, in that there were no black swans, and basically that was proved incorrect, and there were black swans. What is a black swan? Well, it's an event that occurs that is unforeseen. So, 97 was the Asian crisis. 98 was the Russian crisis. 2000 was the dot-com boom bust. 2002, funny enough, was the SARS crisis, which also originated in China. As the gentleman have alluded to, 2007, 2008 was a global financial crisis. Now you get other black swans, other crises that are manifesting on the basis of the togetherness of social media. So, for example, 2011 was the Arab Spring. That was a social uprising in which people, for the first time in the Muslim faith, tended to find a voice. What about 2016? Donald Trump, who would have guessed? What about 2017? Brexit and Boris? I mean, which is worse? January 20 is COVID-19 and the resulting difficulties that have occurred. Around all of this, there are fundamentals and there are technicals. And what you've heard is a technical analysis from James, and what David's done is he's actually fed into that from a fundamental perspective. What has really happened in global markets? Well, as James pointed out, basically into December, you were actually fairly toppy in global markets, but you went into a new decade, and in going into that new decade, global markets actually started relatively bullish. In January, COVID-19 was identified in China, and the first indication that it was serious was the extension of their New Year's holiday, and we know this well because our colleagues are based there, and they had a 3-day extension. What happened? This is exactly back into the sentiment argument that we've heard from James. That affects sentiment. So consumer confidence took a hit. With that, you've got global repatriation starting to begin. When this happens and you have a black swan that's unforeseen, the thing that it affects with sentiment is volatility of markets. And so, of course, you have a volatility spike, and then what you find is a market sell-off starts to begin. And it's it's unprecedented. I mean, you've had the MSCI World Equity Index off 34% in 28 trading days, and then up 11% in 2 days. It's just unprecedented movements, just crazy movements. This was a free fall into a liquidity vacuum, meaning that really what was happening is there was all sellers and there were no buyers. And of course, that then precipitated a huge response from central banks, starting to pump funds into the global financial system to ensure efficient liquidity was brought for all the asset classes, from debt, credit, interest rates, markets, and get the markets functioning properly. And into monetary policy. So I think I'll stop there because I can address sort of monetary policy changes globally for you in a later point.
Excellent. No, thanks very much, Ken, for that. So let's move to Brendan in America, and then we'll come back to Alex. Brendan, we were together two weeks or so ago, and you were talking about what's happening in the American property markets and even what's happening with American banks from a lending perspective. Give us an update. What's happening on the ground around property. I read a thing yesterday saying, has the Fed by mistake caused a housing crash? What's happening in the American market?
Yeah, so Scott, it's absolute chaos at the moment. There's lots of fear. There's lots of greed starting to come out as well. There's lots of love coming out as well. There's people giving deferments to their tenants, allowing them to take a 3-month payment holiday. Like there's a lot of stuff going on in the States, and it's obviously a very, very big market. So I thought I'd give a bit of overview on the macro level, and then just tell some stories about what's going on in our actual portfolio and how we're dealing with it, and maybe that'll give some insights into what's going on. So I mean, at the moment, the hierarchy of risks, so to speak, in the markets in the US in real estate is retail and hospitality are taking an absolute hammering. As you know, hospitals are full and hospitality is empty. So there's a lot of talk about in Seattle, for example, one of the hotels was actually rented out by the government to use as an extra hospital and turned into ICU beds. On the retail side, shopping centers are empty. Amazon's obviously doing really well with their deliveries, but they're also having a lot of pushback from their staff because their staff are saying they're not being protective enough, and a lot of them are actually going on strike. But Amazon's hiring 100,000 people at the moment. Walmart's hiring about 100,000 people. CVS stores is hiring about 80,000 people. So those sort of pharmacy single pad sites are doing very, very well. Our American renal sites and our Fresenius sites are doing very well. And one of those main reasons those medical ones are doing well is you don't miss a renal care session. If you don't have your dialysis, it's very, very, very serious. So the government typically pays for that. And I mean, our tenants are paying on time. Yesterday was the first, and our tenants paid without any issues. So that's going on. Industrial, strangely enough, is still doing very well. Developments are continuing, but they're struggling with workforces and having to keep sort of 10 to 15 people on a site and having to keep social distancing rules and stuff in place. And then Georgia and Florida just went on full lockdown as of tomorrow. So obviously construction sites will stop. So the knock-on effect of this is really going to be, to put it bluntly, catastrophic. And the opportunity that comes out of it is really going to be something incredible. One thing I will say though is the two asset classes that seem to be riding this out in the best form possible is multifamily, which I happen to be in, and medical, which we did a lot of medical together, and I own some medical stuff in our portfolio. And what's interesting about it is you've got to be careful which sector of medical, because if you're in senior living at the moment, it's taking an absolute beating and it's about 60% discount in the REIT market at the moment, because everybody's scared that it's going to have the biggest impact on that age group in terms of the virus impact. That's what I'm talking about. But on the multifamily side is where is everybody getting locked down to? They're getting locked down to their house. So it's a basic fundamental human need. And as long as people keep providing a basic fundamental human need that's affordable, you will always have tenants. I'm not saying that we're going to have an easy ride of this. We've been in sort of chaos management meetings for the last 3 weeks. Every single day, we're micromanaging every single property. We've got over 1,200 tenants that we have to deal with, and across various economic landscapes, from oil and gas to the Delta Airlines sort of area. We've got a property right next to the airport in Atlanta. And strangely enough, our collections are tracking, in terms of March's collections, we're tracking exactly on line with February. And April's collections so far for the first 2 days are tracking pretty much on par with March's collections. So what we've realized is most companies have paid their staff. So far, there have been a lot of staff let go, but they've received retrenchment packages and that type of stuff. So they still have a little bit of money and they're paying their rent. And then what we're also seeing is the federal government just put in place a stimulus package. And what I found amazingly interesting on James's graphs earlier is the sentiment and the movements on the Elliott wave theory are showing that it is probably going to be a downturn, and I agree with that 100%. But obviously they're fighting that downturn with huge stimulus packages. And to give an example, like the total stimulus package estimate of money spent in the 2008 crisis was $831 billion. And the total stimulus package now that they've just launched instantly was $2 trillion. And if you add them up on the previous 700 billion that was launched and the tax incentives and all of that stuff that they're putting in place right now, it's adding up to about $4 trillion. Now, $4 trillion is a hell of a lot of money, and how it's going to trickle down, for example, one of the ways it's going to be spent is people are going to get physical checks. So if you earn less than $75,000 a year, you're going to get $600 a week for the next, I think it's 3 months, roughly. And then obviously if you earn more money, you'll get less money from the government. But I mean, $75,000 a year is $5,000–6,000 a month, maybe a little bit more than $6,000 a month. And on that kind of money, they're giving people $600 a week. And you'd think that if somebody was earning $5,000 to $6,000 a month, they'd have some sort of money to be able to ride through a 2 to 3 month layoff kind of scenario. But it's pretty scary because last week they had the unemployment numbers, and they jumped 3.3 million people in March. Now that's very, very scary because it's effectively 1% of the US population. So they went from 4% unemployed to 5% unemployed in 1 to 2 months, which is very scary. And some of the economists are predicting north of 20% unemployment, which would be absolutely catastrophic. But at the end of the day, if the US finds itself in a situation where it can print its own money and have its own currency hold the debt, they're in a very powerful position, especially when they're perceived around the world as a safe haven asset. So when chaos is playing out, the dollar gets stronger, which is interesting because they can almost print as much money as they want, and their currency is getting stronger. Now, what's also happening in the lending market is absolute chaos. They are squashing deals, they're retrading deals, they're forcing people to put more money into deals. So where you could get an 80% loan to value on a good multifamily asset 4 weeks ago, you're now looking at 65% loan to value. The spreads are getting much wider. So the spread is the difference between the LIBOR or the US Treasury rate and what they actually end up charging. So let's say the US Treasury is at 1%, it's at sub 1% at the moment, and the spread's 3%, you're going to end up paying 4% if they peg you against the US Treasury. What's happening at the moment is they're averaging out at about 4.5% to 5%, but they're putting in place some ridiculous clauses. For example, it's typically 60 to 65% loan to value, but they also want up to 18 months expenses preloaded into a reserve account, and 18 months interest reserve preloaded into a reserve account. So they're being very, very hard on the lending side. What's also happening is lenders are going with past customers only and not accepting new customers. So if you don't have a track record with a lender, you're not going to be able to lend from them. The Freddie Macs and the Fannie Mae say they're open for business, but they're putting in place those ridiculous clauses. And then they're also trying to provide to existing guys that have bonds, they're trying to provide deferment packages where you're allowed to not pay for 3 months, effectively 90 days, and then you have to repay that. If you are able to prove that you've been impacted by COVID, you can get that from Freddie Mac and Fannie Mae at the moment, but you have to repay that deferment value in the next 12 months. But you're not allowed to evict anybody in that period while you're repaying them that money, which creates almost like an Excel circular reference kind of system where you've got a problem where you can't evict people that don't pay, but you also have to increase your income to be able to repay the increase in the bond amount in the next 12 months after your deferment period. So it's not really helping anybody at this point in time. But what we all know is they're not going to be able to foreclose on everybody that misses 1 or 2 payments at the same time. It will just create even more pain. So what all the lenders are saying privately on private calls is that they'll work with us continually to get through this. And they're not going to foreclose on anybody because they know that they can't go and take over the management of those properties themselves. They don't have the infrastructure, they don't have the abilities, and they learned the valuable lesson in 2008 that if they just try and foreclose on everybody, especially all at the same time, 2008 played itself out over 3, 4, 5 years. And I want to finish, I know there's been quite a lot of information quite quickly. I just wanted to cover as much as possible in a short amount of time because we've got so many panelists on here that have got such valuable information to share. But I want to finish with one story, and the story is this: is we started this US journey together, Scott, in about 2012. I'd already bought 1 or 2 properties in 2011, and the reason I bought them was because the 2008 crisis created an unprecedented opportunity from before that to be able to buy properties at a discount. And it allowed me to get into the market with a small amount of money that I had at that particular time. And then as a result of that, we were able to help a lot of other people get the benefits over the last 8, 9, 10 years. And it's obviously played out very well for those that took action very early because their prices moved significantly. Houses we bought for $100,000 are selling for 200, 220 now. And obviously the Rand moved from 9, 10 Rand to 18 Rand 55 as it was today. So they got a double whammy benefit if they're still living in Rands by the decrease in value in the Rand and the appreciation in the property while they were collecting dollar-based income. So where we sit at the moment is in our own portfolio, we're actively managing all our tenants to make sure that our collections are on point. Anybody that is affected, we're not allowed to evict them right now. The courts are closed. So we're managing it. And what we're saying to them is we will give them a deferment program. We've got a lot of paperwork drawn up really quickly by the attorneys to help them through that. And obviously, we're getting a little bit of help from our lenders. But what we're doing is we're keeping the lenders at bay for now, where we're actually going to keep paying them the normal mortgage rate that we have to pay. And then if it gets significantly worse in May or June, then we're going to go to them and say, okay, now we need help. But while we still don't need help, we're going to still keep paying. And that's my story. And I think the opportunity that's coming now is going to be incredible to be able to pick up properties at discounted rates in future.
Yeah, awesome. Thanks, Brendan. I certainly, that was my experience from 2008, 2009. And one of the principal reasons we created the Wealth Migrate was because of the opportunities that existed in 2008, 2009, but we didn't have the buying power of the institutions. Alex, from your perspective, you're a property developer, you're based in the UK. You, as I said earlier, I'm on your site here, and you've also got extensive information for people in terms of all the different areas, how to the development process and the due diligence and everything. So you also love to share and teach people. Tell us a little bit around what's happening in the UK market and what one can expect in these times.
Yeah, well, first of all, I just want to thank the other panelists. They've perfectly set me up to tell all of the investors why commercial and residential property is the best asset class and not stocks and shares and forex. So thank you very much, James. No, but all joking aside, obviously the COVID-19 and the recent crisis has had a big impact on the commercial market and the residential market. And the fact that James was talking about, we could see a 90% loss in stocks also voices what we're talking about as having commercial property and residential property as a solid alternative asset class. And I think most people in this group, in the investment group, obviously also back that as well. Now, over the last month, I've been working a lot with with property experts in the field. We've been working with CoStar, which is kind of one of the world's biggest information and analytics resources for commercial property, and also with the likes of Taylor Capital, Dan Taylor, who's quite big in the commercial scene. We've just been trying to analyse what is the best, where are the best opportunities for investors and for businesses in this market within the UK sector. And, there's been a lot of movement for those in the UK who are not aware of the UK. Very similar to what David was talking about, there's been a lot of stimulus from the government. We've had over £330 billion, which is roughly 15% of the GDP, pumped into economy to support SMEs, businesses, and obviously everyone throughout that sector, self-employed as well as employed normally. So, there's a lot of drive to try and get businesses through this kind of this period. But unavoidably, there's been a lot of CVAs and collapses of business. Bright House, Laura Ashley, some of the more recent ones, and expect a lot more public-facing ones to go quite similar. Now, when I was putting this together, I wanted to try and add as much value to the investors and the community as possible. We came up with a couple of principles, and I want to touch on the commercial opportunity because within USA, we look at commercial opportunities which tie in the back end to a residential piece. And then I will talk a little bit about the residential at the end, so people can kind of get a good understanding. But I think very much in this market, like most people know, they've got to follow the royal principles, is what I've called it. Now, being British, royals, it makes sense. But essentially, what royal principles mean is cash is king, income is queen. And in this kind of market, I think David also touched on it, how banks are tightening up their lending right now. So having cash and having the ability, such as what Wealth Migrate offers, is a really good way to take advantage of a lot of properties coming back on the market. There's a lot of deals which can't close right now. There's a lot of people who are running away scared. There's a lot of deals recycling, and people are only looking at cash lending because some of the biggest high street chains, HSBC for instance, have just shut their doors. A lot of challenger banks have just said, nope, no more lending. So if you haven't got your application in, we're not going to give you any more. So having access to that cash is going to produce some really good opportunities. That said, buying properties which are empty is going to offer some really big risk as well. As we're seeing, the CVA piece, we're seeing a lot of tenants defaulting on rents. We're seeing a lot of tenants asking for rent holidays. So you've got to be very careful about who you're going to bring in, and locking in income from day one with existing tenants is really, really important. So having the cash to buy it, but then buying smartly. And what we're trying to do is, when you say buy smartly, it's about staying away from the public facing side of the service industry, or hospitality, retail, anything on those sides is suffering right now, as we're seeing a lot of shop closures. For instance, Arcadia Group, who are one of the biggest in the UK, have shut down 500 shops across the whole of the retail sector. So, there's a lot of closures that side. Where you want to be and where people want to be looking around is trying to get some really strong tenants in there. And what we see strong right now, your typical low cost, your supermarket, your retailers that are offering products, your co-ops, for instance, your McCalls, but more importantly, government bodies. And government bodies is not just, the government themselves, there's the NHS, the HSE, there's a lot of different subsidiaries that come off the back of that. As we move out of the COVID-19 situation and a bit of normality resumes, stick with your low-cost food services. You know, Greg's is a really good example. Coffee, Costa coffees are always very good tenants to have, and those are going to have, you know, almost recession-proof, as has been proven in 2008. And you want to be able to get, this is in terms of short-term plays, those are the kind of assets and the tenants that you want in. Now, in terms of short-term opportunities, there's a lot of distressed assets coming on the market. A lot of them are in administration. A lot of landlord struggles. It was funny, I was just talking to an investor of mine yesterday, a colleague of mine yesterday. He was looking to bid on a property on Allsop's auction website and had monthly auction a couple of days ago. There was 110 commercial assets, 3 sold out of that auction. So you can see how much fear there is, but how much opportunity is to then go back to those landlords who were hoping to sell those assets and really strip back some opportunity in there. So, you know, there's a really, like I said, going back to these royal principles, cash is queen, but making sure you've got income day one is really important. And I'm going to touch on that and how we're looking at the residential side. What I would say from the commercial side as well, you've got the short-term opportunities which COVID-19, this global crisis, are throwing up, but there's also the mid-term opportunities. And we see that very much centered around logistic-based companies. Light industry, for instance, there's going to be a real resurgence in that, and, you know, working with CoStar to see that there's going to be a really big push in central Scotland where the kind of commercial prices, the capital value, the light industry is very low, but there is a real need to build hubs and logistic bases, such for the likes of supermarkets, Amazon, and also sea haulage firms as we come out the back of Brexit. Within the next couple of years, you're going to see a real big explosion in the light industry sector, and picking correctly some spaces there could see some really big benefits. The other 2 areas, one I'm going to deep dive on just for the next 5 minutes. The first one is dark kitchens, and it's something a lot of people are like, what the hell is a dark kitchen? You sure you want light in your kitchen? Not what it sounds like, but what we're finding now is with the rise of technology and your apps such as, you know, Just Eat, Deliveroo, Uber Eats, what this is now forcing a lot of restaurants, and obviously the back end of COVID-19, what it's forcing a lot of restaurants to do is think about how to centralize their offering such that deliveries can be a lot quicker, a lot smarter, and there's a lot of reduced overheads. You find in big restaurants, maybe, you know, your Nando's or your Jamie Oliver's. Maybe Jamie Oliver's not a great example, but they're now moving to more industrial-based sites, where it's a lot easier for logistics-wise for delivery drivers to come in and then disperse. So they're set up just purely for food. They're not front-facing for the general public. They're just there to deliver. And you're going to see a lot of spaces which were maybe light industry previously, or were not fit for purpose, being repackaged into these darker kitchens. Now, the other space which I think is more interesting, and what I really want to kind of speak to the community about today, is office spaces. And office spaces, I think, are going to offer the biggest potential, and especially for developers or those who have a solid back-end exit strategy. Now, just like I was speaking to you guys before, it's still very important. If you're going to buy commercial opportunity these days, you still need to follow those royal principles. Cash is king to get a good deal, and income day one, which is the queen, yeah? But where we can then differentiate ourselves is by having a really strong back end. So not just relying on, you know, getting an office space and renewing the lease, you know, to a nice big oil and gas firm, or to you know, your Barclays Bank, or to BT Telecoms. Those days are moving. What we're going to see now, especially in the UK, is a complete shift away from long leases. The gone are the days of the 5 and 10 year leases. They're going to be much more flexible, and they're going to be pushed towards a profit share, similar to what's happening, you know, what actually happens in America and like most of the world. There'll be a lot more working together and collaboration between tenants and landlords. There won't be fixed price, you know, and here's your rent for the year. It'll be, okay, well, if we do well, we'll give you a share of the rent. So those things are going to quite quickly go. And so we got to have another offering which, you know, as an exit strategy, which is really capable. And development is that space, and the UK is going to really, really need that space more than ever at the back end of COVID-19. And so what we're seeing now, and you know, if you look at the leasing market in 2019 and 2020, leasing is an all-time low. A lot of vacancy rates are at an all-time high, and this is for grade A, grade B, and grade C. So grade A, you're like all nice, uber posh places. Grade C is maybe like the stuff you see in the 60s and 70s. But we're seeing that the vacancy rates are dropping down, but also net absorption rates are dropping down. Now, for those who may be thinking, what the hell is he talking about? Net absorption is just the physical space which is created and it's on the market is actually being taken. And it was quite high, so we had a positive net absorption rate, but we're now forecasted in this year, especially with what's going on, to have a negative, which means there's an oversupply of office space. Now, what we're also going to see, and I'm sure everyone can agree here, is COVID-19 is game-changing the operational rules for offices. So as more and more people flock into Zoom and go webinar and other similar fintech technology applications to work from home, a lot of business owners, a lot of tenants are probably going to see and ask themselves, why the hell are we spending so much money on office space when we can get just as much efficiency from our workforce and reduce our overheads? So we're going to see an even bigger surge of office space coming back onto the market, and especially grade B and grade C, where I feel that'll start moving into an extinction zone. And there's going to be a lot of worried landlords who are sitting on grade B and C stock who won't know what to do with it. And as that capital value drives down, that provides a really big opportunity within the community and for also developers. Really grab hold of that space and then repurpose it and make something really good of it. Now, just as that grade B space goes up, we're going to see a rise of co-working and more flexible service office space. Now, service office space when I speak about service, it'll be more this profit share mentality where you're working with local business operators to provide some real value to the community. So grade B, grade C go down, co-working goes up, and you know, smaller units for smaller SMEs and business owners to have, which are lower than the business rates threshold, are going to be really popular then. As I was saying, how does this all link back to residential? Well, as we see this kind of splurge of office space come onto the market, there's going to be a real pressure from local authorities and the government to repurpose this, because they're going to sit vacant, they're going to go into dilapidation, they're going to have a lot of problems. The local planning authorities will then have the pressure to do something with this, to change their use classes from an office space to maybe into retail or another commercial aspect, or also residential. And by looking at that extra long-term play, we then at USA are very much prepared for this kind of splurge of office space to come in and offer investors some really good opportunities. And I think this is a really exciting time because we can maybe get hold of an office space with a tail end lease. What I mean by that is the tenants are still in their bound conditions for a year or two. In that time, you can then work proactively with your planning authorities, with public-private partnerships, with your local councils or local social housing authorities, put a scheme together that after that lease is finished, you can go straight into the construction and development phase. You've got back-to-back great income coming in from day one, which you can offer back to investors as security and an additional dividend almost, and straight into the back end of a development and provide that offering to the market. Now,
Alex,
what you would say
Alex, what's quite interesting with the co-working space is that someone should create a platform where those tenants could invest through the platform in the property. I'm conscious of time. I'm just going to. I'll come back to you basically. James, with regards to yourself, I've always been fascinated by your different predictions, and if anyone hasn't seen it before, I downloaded this literally a day or two ago. You've always got the short-term outlook. This is the US dollar to ZAR. I know you do it, so US dollar to Rand, but I know you do it on different currencies. You've got the short-term, the next couple of weeks, the next couple of months, and then the long-term. A lot of our clients are saying to us, look, the Rand has spiked. It's, I don't even know what it is right now, 18.30, it was 15 not even so long ago, 2-3 months ago. And they're saying to us, what should they do? Should they wait? Should they get their money out now? Is it going to be 50? What do you think people should be doing? I don't know if I can use my screen, or if you want me to share back my screen to you. Can't hear you, James.
Yeah, Scott, I think perhaps let me share my screen, my better.
There we are.
On the right one, yeah?
Came up and now disappeared again. Where's it gone again? There we are. Yep. So we're on the US dollar to ZAR medium-term outlook.
Yeah. So what we've seen here, we've actually pushed a higher a shorter-term outlook. We're actually up to about 1870, which I think we're at about 1865 earlier today. But the overall picture is not too much different from this. We're expecting we could test 19. There is high resistance level there. And basically from there, there's two possibilities. The one is that we have some retracement down to sort of 1650 level, maybe a bit less, before we push still higher. But the alternative is that is going to be quite a long-term high, and we should see some substantial retracement following that, with this 15, 17 level being pivotal. So as long as we keep above that, then this is likely a continuing uptrend. But if we break below that, then we should see quite a substantial correction back down to 13 sort of levels.
And I mean, this is your medium to long-term outlook. What do you think? What do you see happening over the next 3 to 6 months?
The next 3 to 6 months, is probably going to be this retracement here. Which the strength and the structure of that pattern will give us some indication as to whether it is just a correction, or whether we're heading a lot further down. But one thing with that is to understand why that could happen is the dollar outlook this is our long-term dollar outlook. The dollar index, we hit this high just about a couple of weeks back of 102.75. But what we're looking at there is that we had this move down, this leg down, leg up here, and now we're having the next leg down in terms of downward cycle. And based on projections, it's looking like the dollar could halve its value over the next few years. Which
against the euro or the pound or what?
Well, this is against a basket of currencies, which is effectively the dollar's trading partners. So if you look at the euro side of things, to actually strengthen quite significantly from these low levels we see. So just on the dollar rand side, we're likely to see quite a pullback over the next 2-3 months, perhaps longer.
Fascinating. When one looks at this, it'd be useful if someone had a platform where you could invest in different asset classes and different currencies so that you could blend it. I want to move to David. David, you've been in Italy, and as you said, you've been at the epicenter of what's been happening with coronavirus, etc. And we've been talking quite a lot about adoption. And what I mean by adoption is that there's a great graph. Just that typical adoption curve graph. I'll get it up while I'm talking. And what do you see happening with everyone, being forced to stay at home, being forced to go online? How is the way of life in Italy changing from the lessons you've learned from Italy? But more importantly, how do you see the world post-coronavirus, not only in Italy, but for the rest of us?
Absolutely. Why don't we take off James's screen, and the video alone is fine. We don't need a chart for you to share. Definitely, the world is in the middle of multiple stages and multiple phases of transformation. And it is something that does not happen all the time. And when it happens, we remember that. We remember as a watershed. We remember as a phase transformation. And according to many who are starting to think exactly what it is going to be, what is the world going to look like after the pandemic is over, they start to think that it will be characterized by many differences. The most apparent and the one that is so easy to see is that those companies that were still crossing their fingers and wanted the internet to be a fad wake up from the nightmare, and for it to have gone away, and digitalization of their processes not to have to happen ever. Now they are in a crash course of digitization. Zoom used to have 10 million daily users in December on average. Today they have 200 million daily users on average, right? A 20-fold increase in the use of their software. And the same with streaming services, as well as billions of people who are thankful and grateful if they are able to work from home, discovering that it is possible, that let alone, and let's not worry about issues of IT infrastructure and security and data confidentiality, very important things. But the culture of distributed teams, where it is not just a tiny percentage of nerds who insist that they can code from home and everybody looks at them as weirdos, but 100% of the workforce is at home, and top management and middle management have to realize that their value is not in breathing down the neck of somebody, because if they are not driven like a slave rowing in a boat, they will slack off. That there are loyal and passionate people in the organization. Those managers have to prove their value. And that is an important cultural shift. And there will be others as well. What is going to happen if and when the restrictions in the free movement of people are lifted before everybody is immunized? And it is guaranteed it will be like that. Is the workforce going to split into officially recognized classes? One of them who are immunized, all the usual rights apply. And the second class of the workforce are those who have the bad luck of not having fallen ill soon enough, and now they are second-class participants, which everybody is shunning. Am I going to visit my mother for the next 2 years, afraid that a meeting a week ago infected me and I'm gonna kill her? We don't have answers to these questions yet. And at the same time, while all this turmoil is happening and our culture is fundamentally shifting, and our mindset too, where, for example, the testing ability we are developing accelerate, and in 10 years we will look back to today wondering how could we live in a barbaric time where we could enter a school or an office building or a shopping center without having been tested against 100 pathogens, and we would just shed hundreds of millions of viruses and bacteria unthinkingly. What a incredibly filthy time to be alive. That will be our mindset as we look back to today, right? But while all this incredible change is happening, the unrelenting transformation of technology is still going along. Solar energy, the electrification of transportation, the almost impossible shift that traditional companies have in order to embrace this, whether they are building internal combustion engine cars, whether they are shipping companies transporting oil from one end to the other of the world. These are going to go bankrupt in almost their totality. And it is not going to be due to the coronavirus. It is going to be due to phenomena that have started already decades ago, but now they are exploding on the consciousness of everybody, because it will be crazy to buy an old style car when the electric car is cheaper, is more reliable, has many more features, and it is just the normal thing to do. So it is important, I think, as we always remark, to make sure that our holdings are as diversified as possible, because to say I know what is going to happen and you can bet on it is exactly that. Is just a very risky bet. And I think that what you are telling our viewers, that the diversified income streams of Wealth Migrate, the geographical diversification of the investment opportunities, these are excellent starting points for creating portfolios that are going to support the people holding them to ride out turbulent times that are necessarily going to be ahead of us. And of course, we can cross our fingers to find business leaders and political leaders who have charismatic messages to spread of empowerment and emancipation, of solidarity and support, of empathy and human dignity. If we find those and we vote for them either in the board of directors meetings or at the democratic elections that we hold, then we will build a society that will be resilient regardless of what kind of violent new tests we will be put in front of. If, on the other hand, we vote for divisiveness, pettiness, lies, and treacherous behaviors, then we can accelerate destruction and self-destruction. So we are free to go one way or the other, and many countries will try one or the other, and then we can look at them and say, oh, that's great, that's what we want to emulate, or, well, that didn't work out that well, we should stay away.
Fascinating, David. So we've all got a choice, and I love what you say there, and I'm not going to talk about it tonight. I did a webinar on Tuesday night, actually, about this adoption curve and how, you know, if you take just Zoom as an example, it was people like you and I that liked to work from home and didn't like to have to go into an office. And so we were early adopters from a pleasure perspective. But now coronavirus creates pain, and people do 4 times more away from pain. So it's really, really interesting. Ken, from your perspective, you know, when you look at quantitative easing and you look at the debt, you know, there's quite a few questions coming through here about the debt and where, you know, not only what is quantitative easing and what is it doing, what is the government stimulus, but where do you see it going over the next 10 years? You know, we can't just keep pumping credit into the system.
Yes, so lots of things to answer there, Scott. You know, in terms of both, I think James's comments and David's. So, you know, what did, you know, governments do from a monetary perspective, and what did they do fiscally? So, you know, so from a monetary perspective, it gave the ability of governments to recalibrate in terms of new forms of monetary policy. So massive, never before seen sort of eye-watering injections of quantitative easing. We saw in the US and the UK, for example, and obviously everyone is on the other side of the credit cycle. We saw you know, rates down in the US to, you know, between 0 and 0.25%. In the UK, lowest ever at 0.1%. What this does is, and combined with that, to go back to Brendan's point, we're also seeing unprecedented levels of unemployment. You know, because if I'm not mistaken, you know, Brendan was correct in quoting the 3 million unemployment. I think the top level of unemployment back in the crisis in the US was about 650,000. So there's significant dips there. What does it do? Well, it's going to precipitate a global recession, and from that, you know, out of this, we're going to be looking at massive debt burdens. Now, I think a couple of the measures that you could look at is things like debt to GDP, but actually for emerging markets. So, you know, the comments that we had from James around South Africa, you'd have to consider those in the context of, and he was talking about a fall in the dollar versus the rand, for example. You've got to consider that in the context of sovereign ratings, because, you know, you sit in a situation in South Africa where you've got a sort of a 66% debt to GDP. You know, but rates in South Africa are at 5.2%. If you look at the UK, we're sitting at 80% debt to GDP, but rates are at 10 basis points. You know, you multiply 80% by 10 basis points if you want to do apples with apples. Multiply 66% by 5.2%. You can see the differentials. So, you know, I suppose the concern is who has the ammunition to actually move through this. In South Africa's context specifically, and it's just because James has mentioned it, I know this is a global call. My biggest concern is you're running twin deficits, you do not have any money in the coffers, and you've just gone to a sovereign rating of junk. In the US, you've injected an unprecedented, as Brendan mentioned, 2 trillion into the economy. Yet your rating has gone from AAA plus to AAA minus, I believe, something along those lines. So remember that the US dollar and sterling have been considered for many years as a source of wealth holding, like gold. So, you know, the question is, I think now, while we sort of all sit here and actually in these unprecedented times, and by the way, world info report on the coronavirus indicates 198 countries affected, 486,000 reported cases, 22,000 deaths, 117,000 recoveries. The global data collected so far indicates that the trend on a daily basis is rising at 11.3%. So you imagine how you compound that, which is where we're starting to see the move out of governments of this isolation precedent to making it slightly longer. So what? And back now to David's points. When you are sitting in a circumstance where you are considering this unprecedented circumstance, it's amazing that everybody that we're speaking to here is in self-isolation, basically, globally. And what we're all doing,
some of us not by choice, though, Kit.
Yeah, we're thinking about how we work. We're thinking about how we relate to our families. We're thinking how we relate to our communities. And I believe governments are going to be doing the same thing. Now, as he talked about, this could mean significant changes globally to capital flows, for example, to political gamesmanship. So, a parting thing on this is, let's just consider another black swan, for example, which really was the oil sell-off. So basically, because of what had happened with Corona and because of the consternation in global markets, on the 9th of March this year, OPEC met in Vienna really to consider the drop-off in demand because of CD19. And what they were considering is the cuts, cutting production. Now, the US, having sort of been beholden to OPEC in the last crisis, has considerably lifted their shale capacity. It's high cost of production, okay, and it's quite indebted as an industry. But what they've done is they've actually moved from, say, 7% to, say, roughly 17% of global production. So clearly, really, what was being said in these meetings was a look at the US in terms of the possibility of cuts. What was very surprising was Saudi. Surprised everyone, and basically after the meetings, cut prices and then also looked to ramp demand because their marginal cost of production is so much lower than the US. Now, what it means is let's have a look at the US and actually some of the gamesmanship that's being played here, meaning no disrespect at all. Taking interest rates down as low as they have in the US does the obvious, which is James is now alluding to, which is that you would anticipate that you get a depreciation in the currency. Depreciation in the currency means that it makes US exports to their major market, which is China, cheaper. China, however, runs the global economy. So China affects the global emerging markets, but it actually drives the global economy. So if China is importing more than it's exporting, China takes a knock. And you've obviously seen Chinese downgrades to GDP. So a massive concern then for the global economy. And what you're tending to find actually is that where you can maintain very good sovereign ratings, you can actually get your workforce that's now sitting in the US circumstance at 3 million unemployed back into work and scale it up quicker than the rest of the world. You will win. And so I think, looking at it, there's where perhaps US foreign policy was incredibly accommodative before. I think that may have changed, and it's going to be interesting to see how it plays out.
Awesome. Thanks very much, Ken. Brendan, there's a question here. You spoke about, and certainly from my experience in America, last time we had the crash, 2008, 2009, 2010, some markets lost anywhere from 40 to 70% in the housing market, depending on what depending on what city you were talking about. Sandra's asked you about multifamily. You mentioned medical. Medical is fairly self-explanatory. You know, I always remember back to that story when I asked those people why medical, and they said, well, think about it. No matter what happens in the global economy, people need doctors, even with Corona, more than ever. Secondly, doctors never leave their premises. And thirdly, doctors, you know, are not good accountants. They sign very good long-term favorable leases. So, you know, medical's been a very good, stable investment option, but so has multifamily. And they were the two most economically resilient in the last crash. But Sandra wants to know, what is multifamily? I know I put a definition up on the screen earlier, and while you're talking, I'm going to get up one of your projects. But just explain to us what multifamily is for those who don't understand.
Okay, so multifamily is effectively a block of apartments that's held under one title deed, so it's not sectionalized. If we would sectionalize it, we'd call it either sectional title in South African or condos or condominiums in America. So it's effectively a block of apartments that's held under one title deed, and when we purchase it, we own it in a special purpose entity that owns the property outright. All of our investors own that special purpose entity together as a partnership. And effectively, we've syndicated the deal, and we use Wealth Migrate's platform to allow people to access these types of properties. So if you have a look at the Oklahoma Class B, that's the one that we bought in November last year. It was a portfolio of 5 assets for a total of 827 units. And each asset was its own title deed. 4 of them were in Tulsa, and 1 of them was in Oklahoma City. What's interesting is 10 years ago, I would not have bought those properties because Oklahoma City back then was about 90% oil and gas. What's great about Oklahoma City now is they completely diversified their economy. They're in healthcare, they're in military, they're in technology, they're in universities. It's got a very diverse economy, and oil and gas is only around 10% of it. And they're the big companies as well, so they can see themselves through this particular crisis. And what we're finding with our properties is we're getting paid our rent. So far, it's tracking very, very well. The assets are what we call B class. So there's different classes of assets. Obviously, they kind of speak for themselves. A class would be expensive, very high-end luxury housing that's brand new, with great amenities. Then B class is what we bought here. So this was the 1980s A-class product. It was built in the 1980s. It's got a beautiful leasing office. They've sometimes got tennis courts. They've got a beautiful pool. Look at that. It's got a gym on site. So they're really, really, really nice. And a great place where even I would be happy to live there. It's not dangerous. They're in good school districts. So they're very solid assets that are affordable. So what's interesting at the moment is the research that's coming out through this coronavirus epidemic is that B-class properties like we bought here are the ones that are going to fare the best in this particular crisis. And why is that? It's if you look at the A-class properties, they're the ones that are more expensive and also have higher vacancies. And right now, if somebody loses their job or has to be forced to work from home or takes a cut in pay or something like that, they're going to be putting pressure on B-class properties. And the problem with B-class properties, and it's a good problem, is that you can't build them for the same price as they currently exist that you can buy them for. So if you want to build new product, the reason there's so much A-class product available is because the only way it makes sense at the current cost to build is to build product for the A-class market at much higher rents, which means if there's no new supply coming online to compete with the stuff that we own, it means we're always in a case of a supply and demand imbalance, which is what I love, because it means our rents are always going up, because the differential, the delta between our A-class product in that area and the B-class product is typically $1,000. So if somebody's earning $5,000 or $6,000 a month and he's paying us $800, $900 a month, the next leg up to get into an A-class property is going to cost him nearly $2,000 a month. He simply can't afford it. It's that simple. Whereas for somebody to downgrade and share an $800 or $1,000 a month apartment is very affordable. And if you look at what's happening with the COVID-19 crisis right now, is if they're going to issue $600 a week or roughly $2,500 a month, we're still only 1/3 of what they're giving to people in the stimulus package as a cost to earnings ratio. So even if the guy loses his job and gets $2,500 from the government, as long as he doesn't have too many crazy debts and stuff, he's still going to be able to pay his rent because it's still in a ratio of 1/3. And most of the time we use that 1/3 ratio for vetting our tenants anyway. We happen to be in a good position in Oklahoma City where most of the time it's only about, the rent is only about 20% of their income. So they're very good units and are very affordable in that market. And I don't think we're going to have any issues with it whatsoever. What we are seeing though is a lot more tenant retention. So people are not moving, obviously, because nobody wants to move in this crisis, and it's very difficult to get a moving company to come out and load your stuff for you and move it. So people are not moving. So we're getting very good tenant retention, but because people aren't moving, and this is now one of the top leasing seasons is going from spring into summer, we're not getting new traffic coming in. So rental on our lease renewals that are now going to come available, we're expecting to not have too much movement in terms of increases, but we're also expecting to not have too much movement in terms of an increasing vacancy as well. So we're pretty much tracking even. And what we're doing to how we structure deals to protect ourselves, on this particular one, I'll give you an example, is when we raised the capital for this, we bought it for $76 million. We borrowed $52 million from Morgan Stanley as a CMBS loan at 4.19%, somewhere around there, on interest only for 5 years, and we've got 10 years. So what's amazing about that is we've got 5 years of interest only to ride out any downturn in the market, and we were able to fix it for 10 years. So we know what our debt repayment is. Then on the $24 million equity that we raised, of that 24 million, we've got 1.3 million in extra capital that we didn't need, but we overraised to have it in as a reserve. The second part of it is we hold $300 per unit per year as an emergency reserve as well out of the income, and that's mandated by our lender that we have to have that as a reserve. And the last part of it is our lender gave us a capex reserve that we're allowed to take out of our bond of an extra $1 million. So effectively, we've got about $2.3 million in reserve funds, not counting what we've already put in reserves from our income that was mandated by our lender. So we're in a very strong position cash flow wise, and we're collecting $660,000 a month, and our bond repayment is $180,000. So we could effectively lose 25 to 30% of our income and still not be in breach of any of our debt covenant ratios and still be able to pay our mortgage from our income without even touching our reserves. If we had to go into our reserves, we could take a 60 to 70% hit on our income and still ride this out for about 2 years. So we're very, very, very strong on our underwriting when we go into a deal, even when it was a fantastic market, because we've learned valuable lessons that it's better to be prepared than for me to have to pick up the phone to an investor when he's trying to save his business back in South Africa and the rand is at 18 rand 50, and I'm saying, we need you to move more money because there's a capital call and we need more money to pay our mortgage so we don't lose the property. I never want to make that call. So we're always very, very, very conservative in our underwriting, in our capital raising, in how we run the projects to make sure we can ride out black swan events like this. So that gives you an idea of how we structured our stuff. And then one other thing I wanted to just add some value tonight is what we're seeing play out in the South African markets is a battle between the legal guys, the commercial tenants, and the landlords. And this is specifically in the retail space, where they're starting to use force majeure as a method to try and not pay rent. The tenants are using that. And if they don't have a force majeure clause in their lease, they're using something called supervening impossibility. Now, what it means, basically, I'll read you the definition here. Let me just pull it up for a second. It's phenomenal because it's in common law, and it's very dangerous for landlords, but it's very powerful for tenants. And we need to be aware of this stuff so that we know how to deal with it if it comes up in our portfolio. So In the absence of a force majeure clause, the common law position will apply. And in terms of South African common law, the doctrine is known as supervening impossibility, where each party's obligation to perform in terms of an agreement and their respective rights to receive performance under that agreement will be extinguished in the event that the performance by a party of its obligation becomes objectively impossible as a result of unforeseeable and unavoidable events which are not the fault of any party to the agreement. So this is very, very powerful stuff. It means that a tenant that cannot access his property because the government told him that he can't go there to run his business can use supervening impossibility as a reason to not pay his rent. We're going to have so much pain in the South African market, it's only just starting. But at the same time, that means opportunity. So let's be aware of it. And if people do own retail stuff, know that this is coming and start talking to your lawyers on how to counteract it.
Excellent. Thank you, Brendan. Alex, you spoke a lot about, converting commercial office space. I mean, I had my first office when at 25 when I became an entrepreneur, and I walked to work in Wimbledon. I've never understood people commuting. We've been on Skype since the mid 2000s and everything like I've already explained. You've obviously got you can see the development that I've got here, which is where it's a mixed use and you're converting office space into commercial in a residential scheme. Talk to us about this and also talk to us, how do you see the future playing out in terms of co-living, co-working, specifically taking into account Corona and everything else?
Yeah, no problem. Scott, can I just share my screen?
Yep, no problem. I've always got to go and look for you guys. There we are, I got it.
Okay. You tell me when you can see my screen.
Not yet. Yeah, there I got it, yep.
Perfect. So, you had that screenshot that was just shown up there, which is one of our projects which we're moving forward in Aberdeen. And that was a 30,000 square foot of commercial office space, which was grade B, which I was talking about, surplus to requirements. It came onto the market and it was a really good story, kind of backups what I was trying to tell earlier about how you can have a win-win as a developer and as an investor. And this particular property, let me just to bring this up in here, just go on to it. Give us 2 seconds. I want to show you something else. So this particular property came on and it actually generated, so we bought it at a very cheap price anyway because it was surplus to demands. But on top of that, we were able to gain over £300,000 in revenue in just over 3 months, essentially because we took the tail end of a lease, and then we got also what's called a dilapidation payment, which was a payment at the end of the lease. And so we saw a really good opportunity here to take those commercial premises that were underlet, that were under tenancy, taking the money out of them, but then also extracting maximum value wherever possible through the development pieces at the back end. Now I just want to show you the photo here so the guys can actually see. This is the existing building here, which is just basically a massive greenhouse, which I'm sure you're all quite aware that you wouldn't want to buy a home in this place. So this is the actual area here in this red square. And it's 1.75 acres, and we're going to convert that. And that was essentially why I just wanted to show you that shot. This is the complex, which you're now going to see. This is very much what we're going to be creating over the next 18 months. And, David was mentioning about it earlier in Oklahoma. Aberdeen itself, which is one of the hubs we look into, they're also now going through diversification, similar to Oklahoma, where they're moving away from the oil and gas. They're moving much more into culture and technology, the BMT, so technology, media and telecoms, and they're really trying to build that cultural awareness. And as you quite rightly said, there has to be a rise, not in just creating affordable housing, which is going to be a must after this COVID-19, not going for that high-end stuff, but you want to create a really good affordable development, which can give you end-to-end living. And you have to offer more than just a house or a home these days. You've got to provide all the facilities that millennials and people demand. They want everything at their fingertips, which is integrated through technology. So our homes and what you're seeing here and what we'll be bringing are all smart enabled. We have on the bottom here, co-working space. So you have co-working, serviced accommodation, which is then blended in to the living at the top space. On top of that, we have a gym. We have units which are then able to be run and self-developed by the community themselves. So they, if you've got entrepreneurs and business owners, they're actually able to take those spaces and turn them into the businesses that they want. On top of that, you will then create new spaces for bars, restaurants, and other catering, which kind of all add in that end-to-end lifestyle. And we really see the need to have that overall offering as the core product under one affordable community umbrella. And that's what we're really trying to strive to do. And with our purchases, really trying to make an impact on Scott.
Brilliant. Thank you very much. I find it fascinating, and I always believe that property is going to be a localized opportunity, and it's always fascinating around the world, whether it's yourself, speaking about what's happening in England and the opportunities, or Brendan in America, or what's happening in Australia or South Africa. There was great insights, Brendan, on what you gave us in South Africa. We've got a lot of questions here, and what I want to do quickly is I just want to show a few slides, and then we can do some rapid fire questions. I'm very conscious of people's time, including all of you who very kindly come and shared your time with the delegates. So we are coming up to the 2 hours, and there's so much information we should probably have turned this into a day event. But as Nelson Mandela said, money won't create success. It's the freedom to make it that will. And the question that we always got for you, and you can see the screen behind me, is: are you a global citizen? And what are you doing to be ready for 2020? Now, I created the slide in the last part of last year, and I don't think I was ready for 2020 because I don't think we expected it to be quite as interesting as it's been so far. But really, hopefully tonight, in terms of trying to add value, you can see that we've brought from many different perspectives. All of these authorities, can go much, much deeper in their area of expertise. If you're interested in the properties, what Brendan and Alex and them have spoken about, and others, are all available on the platform. This is just a screenshot, but you can actually go to the platform. I've shown you on the platforms. If you're interested in the Inner Circle, which is our global community where we learn and grow together, it's not only about the investing, but the education, the community, and the purpose. James and his partner Alex actually put all the information up there. We've got a joint agreement with them where our Inner Circle members get access to that information on currencies and future predictions, etc. So if you're interested in the Inner Circle, let us know. And if you're not knowing, and it sounds like it's a bit overwhelming and everything's happening at the same time, that's why we created the starter pack. And it's really simple. And Lee, if you wouldn't mind just putting the link up in the chat box so that people can literally just click on the chat box. In terms of, you can just go to online.wealthmigrate.com/start in terms of where you're actually at. And I'm going to leave this little slide up now, which has that starter pack and being able to join. Now, what I would ask from the other speakers is, let's try and do this rapid fire. I'm going to ask you a quick question, but let's keep it really short. So James, there's a question here. Why do you think it will not be a V shape once COVID goes? Then the world machine should kick in. The demand is there. Yes, it will take some time to start the engine. James, you with us?
Sorry, I was muted there. Just repeat that, Lisa. Why it won't?
Why do you think that it will not be a V shape once COVID goes, and the world machine should kick in? The demand is there. Yes, it may take some time to start the engine.
Just because, from one point of view, the bubble is bigger than we were, and if you look at compared with 2008, Brendan, you mentioned the jobless claims. It actually came through today at 6.65 million.
Wow.
So we've doubled in the last couple of weeks. That is 10 times more than in 2007, 2008. So we're not talking about the 2008 recession. It's something far bigger. So the debt is bigger. They're throwing more money at it, but at some point the bubble has to burst. It's think of it like having a fire, a forest fire. A forest fire is healthy. It gets rid of all the dead wood and undergrowth and everything, and starts some new, allows the sunlight in and so on, and you get good growth after that. But if we keep on trying to put out the small fires, we're going to hit the big one, and I think this is the big one.
Excellent. David, there's a question here. A point of attention regarding exponential phenomena technology. Over the long run, they don't escape the second law of thermodynamics.
Scott, apologies, guys. Apologies there, David. It's my birthday today, and I've just found out I've got a surprise birthday in all of 7 minutes. So would you please let me bow out kindly to get myself ready? I've been told I've got to get myself ready in fancy dress. So
happy birthday.
Thank you very much for being on your birthday. Get that very quiet. So I hope you have a fantastic time.
No, thank you very much, guys. Scott, for the opportunity, Lee, and all the panelists for an amazing session. Thank you very much for your time. If there is any questions for me, feel free to forward them to Lee, and I'll answer them as soon as I can. Thank you very much, guys.
Excellent.
Cheers.
Thanks, Alex.
Cheers.
So, Scott, to answer the question from the audience, absolutely, we are not transcending the laws of nature. However, the laws of nature leave enormous opportunities that are underexploited. Now, luckily, for example, the pandemic is not going to be exponentially expanding forever. There are only 8 billion humans to infect, so it will become a sigmoid. It will hit a point of maximum infection, and then crossing fingers, we will be ready to be doing like Hong Kong, Singapore, Taiwan, rather than those countries that were unable to prepare because there will be other waves. There is no going back. Our globally interconnected world will try to connect again, both individually. We like to hug, we are social animals, but also our supply chains will be balanced by more decentralized production systems as well. Maybe the US military will wake up to the fact that they are exposed to a single supply of Chinese sources in so many of their pharmaceuticals, for example, right? And that is absolutely intolerable and absurd from their point of view. So there will be changes. However, the fundamental improvement of the way that we exploit the laws of nature, implementing them in our engineering applications, has still enormous potential to go. Computers have been improving for the past 50 years and more, and we are at the absolute beginning of new important revolutions like artificial intelligence or quantum computing, where we are exceeding the previous paradigm, because what I call jolting technologies, that these are two examples of, are not characterized by a mere exponential whose acceleration is constant, for example, doubling every 2 years. They are characterized by an increasing rate of acceleration. So we are really in front of incredible opportunities. It is up to us to just learn as much as we can in order to stick all this knowledge in our brains and then act on that knowledge rapidly, making mistakes that we can survive so that we can learn from those mistakes too, and sharing our learnings, sharing our mistakes, sharing our path so that everybody can participate. And that is exactly what we are doing tonight. So I'm very grateful to have been your guest and to share just a few sentences to everybody who has been following us.
Excellent. Thanks, David. I'm not sure who's best to answer this between yourself and James, but the question was, when the stock market drops, does Bitcoin follow the same pattern or does it go the other way?
Let me answer that quickly. I was somewhat surprised that Bitcoin didn't become a kind of a gold-like asset where people would take refuge in times of uncertainty. But then I was able to explain to myself that people needed cash that they could spend. Bitcoin has been kind of defeated as a medium of exchange. The number of stores that accept Bitcoin as payment are just plain too few. So when people flock to cash, Bitcoin can suffer too, and that is what we are seeing today.
James, what does your graphs tell us?
Yeah, I mean, we have seen it fall off with the stock market coming off, but every asset class is an animal on its own. So if you want me to share my chart on Bitcoin,
go back to you quickly. Definitely realizing next time 2 hours, we need a half day to do this properly. We got your screen?
Have you got it?
Yeah.
Okay. So this is our current long-term outlook on Bitcoin, and here, just looking at our 5 waves up, 3 waves down, that you had a 1, 2, 3, 4, and we're now into a 5th wave up, and then we had this big correction here when the stock market fell. But since then, we've had some recovery, and in essence, as long as we don't break that level, we're expecting Bitcoin to take off from here. So I shared David's views, that with when there's a crisis, persons need cash, and therefore, Bitcoin suffered along with it. But I think through this period, we're going to see persons see the value more of Bitcoin and these other cryptos versus fiat currency, which is backed by government debt, which is just getting bigger and bigger and bigger. Bitcoin isn't backed by any debt. Bitcoin is what it is. It's not some country that's increasing its debt but promising to pay me my dollar back.
There's a couple of questions here about how to get the graphs and everything else. Basically, in simple terms, either you subscribe, and James did give a link for people, and I know that we've also got a special arrangement for people that are part of our inner circle where they get access to it on a monthly basis. So no, for the people asking, we won't just be sharing the slides, for free. This is their intellectual material that they use, and you'll either need to be a subscriber, with James and the team, and or get a watered down version, which we get on the inner circle once a month, and Alex puts up once a month. Alex and James work together, and that goes to all the different questions. People asking euro, rand, short term, What do you anticipate with regards to the euro against the pound? Just some interest. You didn't talk about that, James. Euro to pound.
I haven't looked at it, to be honest. But I mean, we do forecasts on any market. You know, we do a full synchronized Elliott wave analysis and forecast. So if someone wants something in particular, we're quite happy to have a look at it.
Okay. Okay. Someone was just saying when I was putting up the polls, they couldn't see the slides. I specifically did it when there were no slides. It was just people talking, so you didn't miss anything. Matthew says excellent synopsis, Ken. So thanks very much for that on the markets. Where do you think the SA repo rate, currently 5.25%, will be for the rest of 2020? I don't know who wants to give that a go.
It depends what the treasury rates do. So, I mean, if you look at the Fed rates as well as SA, they pretty much just follow treasury yields. So I think those have been heading down. I think they might have turned a bit now. I haven't looked at the SA ones.
Yeah, I mean, I could probably chip in there. You know, I haven't looked at forecasted either. I agree with you completely. You know, look at you know, spreads to the US 10-year Treasury, and you know, you see them. You know, ordinarily probably you know, looking at more like 200, 250 basis points versus you know, still say 500 now. The difficulty is to fend off a rout in the currency in the South African circumstance. It's going to be very hard pressed to drop rates further at this point in time. So there's a balancing act between that and nosediving the economy as well. So you know, I think you know, hard pushed, as I said to you, with the twin deficits that South Africa faces at the moment, and then the sovereign rating downgrade to junk, because you know, it forms you know, a bunch of factors basically against the rand. I think the other thing to do is look at volatility. You know, obviously a volatility top out. So kind of midway through March, it's come back now. I mean, I think you got as high as 80%. I think you're about 50. I think when I last looked, you know, you want, you know, if vol starts to come off, that will give you an idea of you know, benefit in terms of sentiment, and obviously then the markets start to take off. The big thing is to look at the key drivers here, and obviously for emerging markets and for South Africa, it is China. So you know, you really want China to bounce off its latest downgrades in growth forecasts, and you want it to start turning the corner. And of course, that's going to come against what happens in the US dollar. As I say, if you see a major depreciation in the US dollar, it's going to suck in. It will. China will suck in US exports. It'll benefit the US economy. They'll be able to turn around quicker, but it's going to affect China, and it's going to affect global emerging markets, and that in turn will affect the Central Europe, Middle East, and African sector, of which South Africa is one.
There's a comment here about coronavirus and keeping doctors and dentists and stuff at home. I do acknowledge that these times are different, and obviously we you know, unprecedented. We tend to focus on medical centers, which are by primary hospitals, and need to be part of that. Brendan, you lived in Canada last year. Someone just said, yeah, any thoughts on Canada's future being so close to America?
Yeah, I was there for about 6 months last year, and it was beautiful. Got to do some nice skiing and everything. What their future is, I really don't know. I think this COVID pandemic is going to have a massive effect on everybody. I mean, I read something recently that they were closing road borders between Canada and the US, and and making it significantly more difficult for people to travel. And obviously, they're very close partners. So, you know, both geographically and geopolitically. So, I don't know. It's an interesting question. I'll actually go and research it a little bit more. But I think it's going to just have an effect on everybody.
There's a question here, and I'm conscious of the time now, so I'm going to look to wrap up because the questions are coming in as fast as I'm going through them, to be honest. Linda said, with the rand getting weaker, is it prudent to still buy properties in the USA? I'm going to, Linda, do a webinar next Wednesday. So next Wednesday is Wealthy Wednesday, and I've got a whole bunch of models. Brendan and I have been doing this for more than a decade. I've got a whole bunch of models to show you the difference between taking action, waiting based on James's probability of the rand getting stronger, and what impact it means. So rather than gut feel, come and look at the actual research. There's a bunch here saying happy birthday. Is Wealth Migrate expanding into other industries? Yes, other wealth or financial industries. We've got structured notes and debt products now. What about an investment in whiskey as an asset class? I'm sure that there's plenty of good asset classes. I'd imagine that buying real estate far away without someone seeing it will require people to make smaller investments in more properties. Yeah, so that's the whole idea, Guido, of our platform. And you're investing in the partners who are on the ground and have the local experience. But with the platform, it allows you to make multiple investments across different assets in different countries and different currencies. What about the impact of the credit rating on junk for SA? I think you've discussed that, Ken, have you not?
Yes, I think I have. I mean, look, it's not good for the currency. I was very interested in James's graphs. The big problem is debt burden in South African circumstance and how to fund that debt burden, and that's going to be a global phenomenon going forward. And it's certainly going to have an effect on the rand. Looking at the technicals, as James has suggested, is possibly the rand rallies back a bit, but I am skeptical. I've just been looking at bond spreads here, and it's as I say, 250 basis points may be normal, but sort of 500 to 600 basis points isn't necessarily. Does South Africa have the room to actually drop rates? They did an unprecedented 100 basis points recently. Can they do that again? It's questionable.
But
So
chip in there.
Yeah, go on, James.
Yeah, just of interest, we did have a chart up, but with just for looking at similar countries when they were downgraded to junk. Russia, the ruble actually strengthened 32% in about 4 months following junk status. And Brazil strengthened 25% in 12 months. So it's counterintuitive, but that's what actually happened. So I mean, the longer term picture is obviously not as good, but sometimes it's the persons have anticipated that already in the market. So it's you get a retracement off that.
Can I ask James if you can put up the code that you had and the link in the chat box so that people can just can get access to it, and either that or reach out to Lee and she'll be able to assist you. I'm going to wrap it up now. Sorry, James.
I see it. Lee put it up.
Oh, Lee's put up already. And Lee, if you wouldn't mind putting up the starter pack as well, if people want to get started and the inner circle, etc. So just closing comments from everyone, including you, please, Lee. Let's go in the same order as we started with the introductions. What I'd like to say is that we're in an unprecedented time, as we've all discussed. There's been economic crashes and all that in the past, but there's never been every person almost anywhere in the world being forced to be at home. How do you see the next 3 to 6 months, and what is your one piece of advice that you would offer to people listening as to what to do in the next 3 to 6 months? Closing comments from each of you.
Thanks, Scott. So firstly, to our panel, thank you very much. It was an absolutely fabulous webinar, so much content, and I agree with Scott. We should have made it, instead of a whole day, an entire weekend. I think people would have just been online continuously. It was amazing. As someone who is currently displaced with the current world events, I would say to people that there is so much out there that we can learn And so many people are offering their time and their expertise for nothing, or for very little. So this is your time to grow personally, to grow financially. It is the time to seek out those little bits of sunshine in this rather dark time. So look out for the opportunities, take advantage of it, learn from as many experts, and listen to what they're saying, because these are people that have thrived through all the previous recessions and crashes. So just take in as much as you can. Don't back and don't be scared, because at the end of this, we will continue and we will come out stronger.
Awesome. Thank you, Lee. Brendan, I think you were next.
So I just want to say that that there's positive and negative in everything. Like the world, the universe works in rhythms. And while we've had a great bull market and great positivity and sentiment for the last 10 odd years, maybe not so much in South Africa. There's been some negative sentiment in South Africa for a little while, but it's been getting better for the last year or so, up until recently. So it's been very interesting watching the pendulum swing to the other side, where there's significant negativity in the world right now. And one of the sort of stoic philosophies, for want of a better sort of way to think about things, that's been holding me and my family together has been one simple thing: is this thing is not happening to me, it's happening for me. So if I hold that philosophy in my head often, and try and expand on that and say it's not happening to my parents or my friends, or it's happening for them. How can I help them? How can I help myself? How can I help other people? If we're all asking ourselves this fundamental question, it's going to become apparent that that a consciousness shift is very definitely going to happen in the world, and on a very massive scale, especially when you've got time at home to sit and think about it. So I think that this could be one of the most incredible shifts on the planet, because as far back as the negative pendulum's going to swing, it's going to swing the other direction even further on the positive side. And when that happens, we're going to be in a different world, in a different state, and we can't even imagine how great it's going to be. So while you're in this state of fear and panic and anxiety and not sure about your business, not sure about your family's health, not sure about your parents' health or your children's or anything like that, it's a very significant thing. Just hold true to, we're resilient, we're strong, we're humans are like cockroaches. It's very difficult to get rid of us, and we will make it through. And there's we don't know what the universe is going to hold on the other side of this, but I can tell you that when it swings back the other way, if you've positioned yourself well and you've learned well and you've partnered well with good people, you're going to be okay.
Thanks, Brendan. David, I know you got to go, so let's go with you next. Final comments, and thanks for your time as well.
There is no better way to learn than to do. So whatever you decide to do in order to take advantage of your situation, certainly acquiring new skills, new knowledge to act upon, you can do it by doing. And that is why our digital world today is so different than not in previous times when similar pandemics afflicted millions or billions of people. And the reason why it is different is because we can do what we are doing now. I have also started a daily live stream in my studio. I'm on the 13th daily episode as of today. Tomorrow will be the 14th. And I invite you, just search my name on your favorite platform, because I am actually streaming it simultaneously everywhere. And whether it is Facebook or YouTube or Twitter or even Twitch, which used to be for e-gaming, but now is being attacked by boomers like me. And you can also do the same. Everything that you learn can be shared with others in your own community. And by doing that, you acquire confidence, knowledge of the tools, ability to formulate what you think and find better questions to ask. The benefit is going to be just huge. And that is what I would like all of us learning by doing in order to be able to ask better questions and act on them rapidly.
Awesome. Well, David, be safe in Italy, and I look forward. We've had some fantastic times face to face, and I look forward to seeing you face to face again. So
Absolutely.
Thanks very much, mate.
Thank you very much.
Ken, from your perspective.
So I actually have to go. This live stream was 2 hours long, 2 hours and 15 minutes, and it has been a real marathon. Tomorrow, we are going to have a new session of Searching for the Question live. In closing, I would like to invite you to look up past episodes on the playlist that you can find on davidorban.com/sftql, Searching for the Question live. Join the community to discuss, share questions and understanding on our Discord server at bit.ly/davidorban/-discord, and sign up for my newsletter that you will receive weekly on bit.ly/davidorban-newsletter-sign-up. And of course, you can support the show on patreon.com/davidorban. See you tomorrow.